Good morning everyone, this is Sakis Paraskevov, fundamental analyst at IronFX Global, bringing you the morning comment for the 26th of October. China's ruling Communist Party opened a key 4-day meeting today that will focus on economic and social targets for the next 5 years. Following the soft GDP data for Q3, the People's Bank of China cut interest rates for the 6th time in less than a year on Friday to support the slowing economy. It also lowered the reserve requirement ratio and unbounded the interest rate market by removing the ceiling on deposit rates. The latter will allow the banks to price loans according to risk. The next 5-year plan is likely to reduce the GDP target to around 6.5% from 7% and continue to shift to a more sustainable growth model focused on consumption. Already, government officials downplayed the existing economic growth target, which raised expectations for a new normal of slower growth. A slower growth is likely to weigh on Australia and New Zealand, whose economies are heavily dependent on exports to China. Aussie and New Zealand dollar could come under renewed selling pressure, but much will depend on what will be the measures the Chinese government will take to maintain that growth range. As for today, we have a relatively light calendar. The most important indicator we get is the German Ifo survey for October. Both the ZUW indices for the month declined sharply as the Volkswagen scandal, coupled with the weak growth in emerging markets, deteriorated the economic outlook for Germany. Expectations are for all three Ifo indices to decline as well, something that could put euro under renewed selling pressure. In the US, we get new home sales for September and expectations are for a modest decline. However, following the improvement in existing home sales, housing starts and building permits for the same month, I don't expect new home sales to change investors' view over the strength of the US housing sector. We could even see a positive surprise, something that could boost the greenback somewhat. The Dallas Fed Manufacturing Activity Index is also to be released. We have only one speaker on Monday's agenda. ECB Executive Board member Yves Mersch speaks. As for the rest of the week, we have a very eventful week ahead of us, with several central bank meetings, including US Fed, as well as important economic indicators. The spotlight will be the FOMC monetary policy meeting on Wednesday. At their last meeting, Fed officials decided to remain on hold as the market had expected, but surprised investors with a very dovish outlook. They lowered their inflation forecast and lowered their median forecast for end-year Fed funds by 25 basis points for end 2015, 16, and 17. Moreover, they do not see core inflation moving back up to their 2% target until 2018. Which means probably that even when they do start hiking rates, they will only hike slowly and perhaps stop at a lower rate than expected. What is more, the committee did discuss the idea of hiking rates at this meeting, but decided not to because of global factors. With no press conference scheduled or new forecasts available at this meeting, the focus will be on the statement accompanying the decision. Even though there is a minor chance of a hike, we would expect the committee to remain on hold and wait for signs of further improvement in the US data before risking a liftoff. We expect the statement to reflect the latest weakness in job growth, but this could be downplayed again as several Fed speakers did recently. We will also look through the statement to see if the majority of Fed officials still wants to hike rates this year. On Tuesday, the main event will be the preliminary UK GDP for Q3. The forecast is for the growth to have slowed from Q2. Given the strong industrial production for August and the much better than expected retail sales for September, we see the likelihood for a positive surprise rather than a slowdown. From the US, we get durable goods orders for September. The headline figure is expected to fall for a second consecutive month, while durable goods orders excluding transportation equipment are estimated to have remained unchanged after falling somewhat in August. The focus is usually on the core figure, where a positive surprise could suggest a possible turnaround in business investment and could support the dollar. On Wednesday, besides the FOMC, two more banks hold their monetary policy meetings, the Riksbank and the Reserve Bank of New Zealand. The Reserve Bank of New Zealand is expected by most forecasters to keep its cash rate unchanged at 2.75%, but the minority of economists, including us, believe that another 25 basis points cut could be in the works. At its last meeting, the bank cut rates by 25 basis points, and Governor Graeme Wheeler recently said that further easing seems likely, but this will continue to depend on the emerging flow of economic data. Since then, inflation rose a bit, but still lies well below the bank's target range of 1 to 3%. In addition, China's slowdown keeps inflationary pressures in New Zealand weak and could prompt the RBNZ to act again. On Thursday, Germany's preliminary CPI rate for October is forecast to have risen, which could indicate a rise in Eurozone's rate to be released on Friday. This could support the euro temporarily, but given the more dovish than expected remarks by ECB President Draghi at Thursday meeting, we could treat any rebounds in euro as providing renewed selling opportunities. In the US, we get the first estimate of quarter 3 GDP. Given the drag from net exports and slower inventory accumulation, expectations are for a significant slowdown in quarter 3 growth, despite the solid growth in private consumption. The quarterly PCE deflator is also forecast to have slowed. On Friday, the Bank of Japan monetary policy meeting will take center stage. The bank will also publish its semi-annual outlook report for the fiscal year 2016, where it is expected to cut slightly the outlook for both growth and inflation. Even though Japan's economy shrank in quarter 3 and might slip back into recession, bank officials could refrain from adding fresh stimulus into the economy. Bank of Japan Governor Kuroda and several policymakers maintain their optimistic tone regarding the underlying trend of inflation and still expect that they will meet their 2% target. As such, many members see no immediate need to ease further, stressing that a tightening job market will lead to a wage growth and boost consumption. We will need a substantial downward revision of inflation and growth forecasts for the bank to expand its already massive QQE program. As for the indicators, we have the usual end-of-month data dump from Japan. However, we expect the data to pass unnoticed this time, except the CPI data, as investors' full attention will be on the Bank of Japan policy meeting. In Eurozone, the preliminary CPI rate for October is coming out. For more information, including technical analysis, please read the full comment on IronFX.com or download our app and get all the information you need to trade delivered directly to you. And also, follow us on Twitter, like us on Facebook, subscribe to our YouTube channel, or circle us on Google Plus to get more trading ideas. This is Sakis Paraskevov, fundamental analyst at IronFX Global, wishing you solid trading.